How's it going, friends and family? My name is Amos. Welcome back to another episode of Compounder's Corner. In today's podcast, we'll be breaking down the company's reporting earnings this week, along with the biggest themes and developments shaping the stock market. By the way, I hope you're having a good day, because if you're not, you can just take your mind off of some things and just listen to me talk about the businesses that I care about, that are on my watch list, that are flying under the radar, that we should be paying attention to, and much more. On a high level, here are the biggest takeaways from this week's earnings. Number one, we have the winners of the AI data center build out, including Google, Intel, and Texas Instruments. And as for Google, the company name is Alphabet, but I feel like everyone just is synonymous with Google, right? So for Google, the markets are going to pay close attention to their commentary on CapEx spending. Like, are they going to increase their budgets to build out even more? Are they going to cut spending? I'm telling you right now, the moment one of the hyperscalers simmers down and they say, you know what, we're going to work with what we've got, because our software updates are able to optimize our capacity instead of building out physical infrastructure, I'm calling it right now, their stock price is going to 5, 10, 20% on a single trading day. And the markets are also going to care if they're seeing a tangible ROI on the build out. So in layman terms, their Google Cloud growth, like if they're going to be spending billions of dollars, is it going to be worth it? Are we going to see realized revenue from it? And then we also have IBM reporting their earnings on Wednesday. And they went on record this past week by saying they genuinely messed up. So I think whatever happens, it'll be priced in. And that's why leading up to that confessional, IBM, they were what? 290 something a share, and then immediately afterwards they flirted with almost $200 a share. So yeah, priced in is what I'm predicting, but I could also see the markets punishing them further if they have even more bad news to disclose. And then also this upcoming week, we have the big financial institutions reporting, a continuation of last week. So if last week is any indicator, they should be thriving. All the big banks, financial operations, they're crushing right now. And then there's also the options wheel strategy favorites, including Verizon on Friday. We have AT&T on Wednesday and GM Motors. And then there's a bunch of household names that aren't as popular, such as Domino's Pizza, Boston Beer, Columbia Sportswear, and Decker Brands, which is the parent company of Hoka One One. And now, before we hop into each day of the week on a deeper level, let's talk about last week, a quick recap. So I think the biggest name for me, Netflix on Thursday, had a pretty rough earnings for a company labeled as growth. Well, I mean, I got to give them some credit. By all regards, for the past 3 months, absolutely crushed it, and they even bought back $4.7 billion worth of their own stock, and they increased their top line by 13.4% year over year. However, their guidance for the next quarter, not as bullish, and, dude, I hate to say this part because I don't like less transparency. But they're going to be less transparent with their KPIs going forward, which includes the numbers for subscriber growth and viewer engagement data. I don't like it. I don't like it at all. I can see why the markets were very emotional about it. But what I am a fan of is their margins across the board getting better and better. Which means, think about it like this. For every dollar Netflix makes, they keep more of it as profits. So they're becoming a more optimized and a profitable operation. Again, I think their earnings sell-off absolutely valid and it makes sense. I guess when it comes to Netflix, my only concern, I think for them, this must have been just a fluke of a quarter. I guess for the next one, I think it's going to be business as usual. However, my only concern about Netflix is the younger generation's attention span getting worse and worse because they prefer the TikTok style of content and videos that are only a few seconds long. I mean, even on this channel, it's slow form and it's long content, right? Most of the uploads are 30 minutes, an hour, sometimes 2 hours long. And almost every single upload, I get comments saying, dude, you need to make your stuff shorter, shorter, shorter. Okay, here's my thing. Just like my investing thesis with Abbott, the growing senior population in the US, think about it. Every single day, there's more and more people that are turning 65, 70 years old, and they're retiring and they're just spending all day at home. Maybe they play some pickleball. Maybe they watch Fox News. But there is a growing population that's going to prefer Netflix. And they're not going to be gravitating towards TikTok. So I think the investing thesis for Netflix is still pretty strong. And something else that I missed out is internationally, they're crushing it. They're growing beyond belief. Just here in the US, it's starting to get a little flat. But overseas, that's where the growth story is. And then also last week, we talked a lot about Cintas. It's probably one of the more boring companies in the S&P 500. They're in the business of renting out uniforms, cleaning supplies, nothing sexy. And after their earnings, dude, they shot up so high. And that's because they had a beautiful 3 months. So if you think about it, in the past 5 trading days, Cintas right here, they're up 13% for the week. For most people, when it comes to investing, after 365 days, a full fiscal year, when it's all said and done, 13%. Now, for Cintas, in a single trading week, no, they're not a semiconductor stock. They're not in the business of AI or building data centers. Well, I guess sort of, because as more and more companies employ construction workers, janitorial staff, right, they will be renting out uniforms. So I guess in a way, a secondary play. But nonetheless, a boring business operation to get 13% on a single trading week. That's why I say you can always make money in many different ways in the stock market. You don't have to just follow the herd. And then, of course, last week, we also had my beloved Abbott, one of my core positions in the public portfolio series. When they reported their earnings, I'm not going to lie to you, dude, I was so freaking happy because their business is businessing. They had their single best trading day in their stock market history as a publicly traded entity. I'm a pretty happy camper, and no, I do not plan on selling right now. My cost basis, I forget what it is. It's like $88, maybe $89 a share. They're currently $100. I do think day over day, week after week, until their next earnings, until they give the market a reason not to believe in them, I think they're going to continue trading higher and higher. No, I don't think it's going to be plus 50%, let alone plus 150%. But I do think we're going to be seeing like plus 1% per trading week. So why would I sell? And then last week, we also had United Health report their earnings. And everything they said that they were going to do last year when they had that whole debacle of going, 50, 60% into the red, they're like, hey, I know things are rough right now. Our margins are being squeezed. Medical costs are rising. More and more senior citizens are seeking out treatment. We're getting crushed from all angles. The public hates us. Our allies in Congress turn their backs towards us. Like, it's rough, but we have a plan to turn this thing around. Dude, they've been executing. Don't shoot the messenger, but I genuinely think they have the ability to hit 450 by the end of the year. But I think that's too conservative. I think United Health could flirt with $500 in the month of December. Now remember, my original price target, $600 a share. But I thought that was going to play out over the next 2 to 3 years. But to see them be on an expedited path, it's pretty remarkable. Now, the reason why I'm highlighting and focusing on United Health is because at one point I had 1/3 of my freaking Roth IRA dedicated towards them, plus a huge chunk of my individual taxable brokerage account, because I believed in them. Now, it's a very polarizing business operation because on one hand, deep down inside, a health insurance, I don't think it should be for profit. I do think it should be a nonprofit. And on the other side, they had all of the scandals, the setbacks, and everything else. So it's like, I get it. It's polarizing. But I sold, I walked away. I don't think I could invest back in United Health. I don't think I can invest back into health insurance. Having said that, let's go ahead and jump into each day of the week on a more dedicated format. And to kick things off on Monday, scrolling on down to Domino's Pizza, ticker symbol DPZ. The top line expectation is growth of at least 3.3%. Hey, the profitability per share at least 10%. That's pretty high expectations for the bottom line. And when we take a look at Domino's Pizza for the past 1 year, been a pretty rough situation for them. I mean, they're just getting hit with bad news after bad news. I mean, most recently, their CEO, Russell Weiner, announced he's walking away, while at the same time, they're falling out of favor with Wall Street. Now, when it comes to Domino's, I really like them. Between you and me, they're my most favorite pizza chain. I think Blaze Pizza is up there as well, but after sitting with it for a while, Domino's Pizza, I genuinely do not think they have an economic moat. Now, I think a case can be made, maybe their scale and supply chain of ingredients, if I was reaching. At the end of the day, there's nothing to stop the consumer from getting a pizza from Costco's food court, or a pizza from Papa John's, or even frozen pizza from the grocery store. There's no differentiator. But, and this is a big one thing I do understand is the cost of groceries and eating out, it's going up and up and up. So, the fact that you can still get 2 medium pizzas with, I think, up to 3 toppings for $6.99 each, I think that's a value proposition for low-income customers. And I will stand on this hill. If I had to invest in pizza, it would be Costco. Number 2 would be Walmart through Sam's Club. But number 3, I know that's crazy, but number 3 would be Domino's Pizza, if I had to. And so on Monday, I'll give Domino's a quick look, but it's not something that I'm going to be anticipating or get excited over. Now, jumping back on over to the earnings calendar, do we have anything else on Monday? We have AMC. That's just... AMC... I used to be really interested in them back in 2019, before they became a meme stock. And I'm not exaggerating when I say it probably has some of the worst management that I've ever seen for a publicly traded company, especially with what they have been doing in order to turn things around. Just for me, I would never invest in AMC. Anything else? We got the regional banks. Maybe it's a good time for me to tell you guys this. So for full transparency, I monitor stocks when they report earnings so that I can take advantage of when the market acts emotional. Because it happens all the time, right? Because when it happens, sometimes they can go 20, 30. I've even seen 35, 40% in the red on a single trading week. Sometimes maybe up to like 25% on a single trading day. And when that happens, I can scoop up the shares of a high quality compounder that's been on my watch list for years on a discount. Now, sometimes they sell off as justifiable and I don't want to jump in. It's a trap. But other times, dude, it's a gift. And when the stock market gives you a gift, I take advantage of it. So you have to understand this content, this podcast, this YouTube channel, my commentary and language is that of a value investor, a dividend growth guy, and every now and then GARP, which is growth at a reasonable price. And what else? Instead of going all in at once, like lump sum, I do dollar cost averaging. And then last but not least, I'm also a contrarian investor. So when everyone is bearish, fearful of an industry or sector and they turn their backs towards it, that's exactly when I like to jump in. Now, obviously not at the onset. I like to wait a little bit, see if it drops any further, but if it bottoms out or stabilizes, that's when I jump in. Mainly for the software sell-off that's been happening, I pulled the trigger on S&P Global, Microsoft, and SAP. Just like last year with health insurance, I invested in Humana, Centene, and United Health. Just so you understand where I'm coming from, because not everyone would see eye to eye with me. Some people look at stocks as just tickers to day trade. Some people don't believe in the idea of buying and holding for the long term. They just do swing trades. So now that you understand my philosophy, hopefully the words that I'm saying makes more sense. But when we jump on over to Tuesday, I think the most relevant name is third on the list by market capitalization. The expectations are razor thin and it's like non-existent. The top line to grow by 2.8%, the bottom line to grow by 2%, and that's going to be Danaher, ticker symbol DHR. Now, I don't know if I talked about them on this podcast, but I've been pretty vocal of Danaher on the Patreon. Now, past 1 year, 5% in the green, year to date, negative 11%. But if we zoom out, right, that's short term. If we zoom out and take a look at them in a bird's eye view, 22,000%. Now, obviously, they've been falling like a rock since 2021. It's a dividend compounder with cheese in their DNA. And I've been eyeballing them for a hot minute. Danaher, let me take a step back. They manufacture and sell the supplies, equipment, and software for the life sciences and biotechnology space. And the reason why they're hurting is because biotech and startup pharmaceutical companies, they rely heavily on being leveraged, taking out loans. And for them to stay afloat, when the interest rates are like, 4%, it's a lot more difficult, right, for their loan obligations. And so since their customers are hurting, Danaher consequently is also not thriving. But for me, when you think about the interest rates, I don't think we're going to be at a 4% rate forever. Obviously, there's some doom and gloom economists, so-called economists out there who think that's going to be the new norm. But eventually, interest rates will be cut. It's going to fall back down to 3%, 2%. It's going to stabilize. And for Danaher, I would really want to take advantage of the situation. It's just not at their current price point. I do want them to fall a little bit further because I do think they're trading for way too much of a premium for the numbers that they're executing, plus the environmental conditions that they're operating in. It's not a favorable atmosphere. So to pay at 39 times their EPS, I think that's too fat. Okay? Maybe they can go on some GLP-1 drugs, lose some of that weight. But jokes aside, I do think Danaher is a really good business. And maybe this is selfish. Maybe this is not kosher. But I truly hope things don't go well for them so I can buy them. Because they're close to the number that I do want them at. You know what? I'll just give you guys a freaking freebie. Okay? So on the Patreon, I publicly said that I was going to buy them at $159.99. Now, call me crazy, but I missed it by freaking 94 cents. So I almost pulled the trigger, and my buy limit orders are still in place, just never executed, because Danaher reached the low back in the middle of May to 160.93. So if they hit 159.99, I am in. I'm so freaking excited to be able to buy them. But if it doesn't work out, it's okay. I'll live to see another day. Because Danaher, they're probably company number 47 on my watch list of like 100 stocks. Which means I still want them. It's just, if they were probably in the top 10, I'd probably feel a little more upset. But anyways, jumping on back over to Tuesday, we have Chubb, an insurance conglomerate. There's Capital One Finance. There is 3M. Man, talk about 3M for a hot second. I actually bought into 3M when they were selling off due to all the lawsuits over their earplugs and I think the Forever Plastics or whatever it was that they were dumping into rivers. Makes sense, okay? Sentiment surrounding the company was really poor. But if you understand 3M and the amount of patents that they have across all industries, dude, they make the most random products and they have a patent for it. Like the dishwashing sponges, Velcro, window tint. So it's a company that I bought heavily into in 2023 leading up to 2024. I did not time the bottom perfectly. I think my cost basis was like $95. If you look at what happened to them since their little dip, approximately up by, if you take a look at the value price of 86, they're approximately up by 100%. That's why, friends and family, when it comes to high quality blue chip household names, I do like to buy the dip, especially when the sentiment is a little too exaggerated. I remember people talking about how 3M was going to go bankrupt. And I was like, do you understand the history of this conglomerate? A company that's been around for 100+ years? Then again, the financials, they were pretty rough for the years that I jumped into them. But anyways, 3M, I like them. No, I'm not interested in buying into them anymore. But anyways, we also have Keycore, Equifax. They're probably the lowest quality of the credit rating stocks, including S&P Global, Moody's, TransUnion. Equifax, to me, I don't really like them. Ally Financial. Let's see. Man, there's a lot. Hancock Whitney, Regional Bank. There's a lot of regional banks here. There's Alaska Air Group. Maybe we could talk about this one for a quick minute. Now, hear me out, okay? I know you can make money from investing in airline stocks, and that's why Warren Buffett went on record by saying no matter how much he hates the airline stocks, he can't help himself and he invests into them time and time again just to lose money, and he hates them, but he still does it. Me personally, it's not my cup of tea. I know some of you are bullish on airline stocks. I just don't see it. Okay, because I think there's too many variables that are out of their control that hurts their business, such as the sensitivity to fuel costs, the ebbs and flows of consumer travel. Like if there's a pandemic and travel is shut down, you can kiss all of your numbers goodbye, like 2020, negative 60% in the red for their top line. I mean, you have to admit, that's pretty atrocious. 2019, they posted $8.7 billion. And then in 2020, because travel was shut down, $3.5 billion. I'm not trying to say another pandemic is coming up in the next week or so. I mean, maybe if that diarrhea causing lettuce becomes wildfire and now it's all in all of our foods. But jokes aside, just to show, like prove a point, that they're really sensitive to external variables. And the standard practice of drowning in debt, it's just unappealing to me. I would rather buy a company that's flush in cash, low in debt, and despite the macro environmental conditions, they somehow find the way to go up and to the right for all their numbers. Now, their cash position is pretty impressive at $1.7 billion. So right now I'm looking at the balance sheet. It basically tells you the company's books. Like how healthy is their debt situation? That's my biggest takeaway from the balance sheet. If we scroll on down and take a look at their total debt, I mean, that is atrocious, is it not? $6.6 billion of debt, and it's only growing by the year. Now, there are some publicly traded companies out here where their board of directors and their executive leadership team, they are laser focused on maintaining a stabilized debt situation. So like no more than $5 billion. Okay, and so year after year, you'll see for the past 20 years, it'll be $5 billion. But for the airline stocks, that's not how they operate. So their debt situation has tripled since 2018 of $2.1 billion, because right now it's $6.6 billion. So when you compare that to their $1.7 billion of cash on the books, yeah, it's a lot of debt. So as they say, you get what you pay for. So airline stocks such as United Airlines, Delta, American Airlines, Alaska, Ryanair, you get what you pay for. It's a highly cyclical, volatile business that is not a sleep well at night investment, in my opinion. Now, having said that, I do understand that not everyone is a buy and hold investor or invests for the long run. I try to invest for the long run. I can't necessarily say that I'm a buy and hold forever because I do really reevaluate my positions every quarter to make sure that the fundamentals still make sense. Is the investing thesis still on track? And a bunch of other questions that I have to answer. But for the most part, I do like to buy a company with the vision of holding on to them for the long run. Like if the business is continuously just businessing, then I'm going to hold on to it. But I will go on record by saying there are some positions that I just don't plan on ever just selling out of willy-nilly reasons. That includes my VU, which is the S&P 500 ETF, VTI, which is the total stock market of the United States publicly traded companies, but also SCHD. As a short-term play, which even the way that I just said it, it's risky, right? It's risky. If I were to do Alaska Airlines, theoretically, I would want to buy them at their low end of the cycle, which is really hard to predict, and then sell out of them when they have their little rebound. So it looks like, I don't know how many of you guys are into technical analysis indicators, which I'm not going to pop up and go over right now because that would take way too long. But you can see with Alaska Airlines, they do seem to have inevitable high and valley, so like mountain peaks plus valleys. But I'm seeing a trend to me that's a little bearish in that the peaks are getting lower. Since 2025, $75, and then the next peak was 63, and then the next peak was barely 60, and then this next peak was 53. So if I had to make a guess, I think their next peak is going to be like 49, while at the same time, their valley, before they have their rebounds, it gets lower and lower as well. So if this plays out like it has been for the past year and a half, maybe their next valley will be like $32. So if I theoretically had to do it, which I don't want to, considering their PE ratios of 73, based on next year's EPS of 60, I don't think they're a value proposition at all. Like, if they were a high quality enterprise, this would be a different conversation, right? But I think Alaska Airlines and all the other airline stocks, low quality. So to be trading at a fat valuation like this, while at the same time a freaking high quality compounder like Meta has a 19, or Microsoft has a 21, or SAP has an 18, it doesn't make any sense to me. Like, why would I buy a highly leveraged sensitive business when I could just buy some of the best operating companies in the world that have a undervalued trading multiple? But anyways, if I had to, I'd probably buy them at around 32, 33 bucks and then sell them when they hit their little peak at $42, $43. If I had to. Luckily, I don't have to. Just showing you guys my hybrid perspective. So I think it's admirable that some people only have one strategy, like dollar cost average every 2 weeks. It's a VTI, call it a day. Like, I think that's sound, right? Because over the long run, when it's all said and done, your CAGR will probably be like 15%, which is good. There's other people that just day trade, right? They buy a stock, sell out of them by lunch, just to buy back into them at 1 p.m. and then sell out of them at 2:30. There's other people that do dividend growth investing, which means they reinvest the dividend payouts until they get retired so that they can buy more shares to allow their compounding income to get bigger and bigger there's many different styles. And what I'm saying is I see merit in all of them, right? And that's why I just follow the best practices and I just try to do a modified hybrid approach because different companies require a different approach. So like if I had to do Alaska, here's one that I would do that I just haven't had the time to reevaluate is Kura. So the reason why I went on that little tangent is this is a company that I'm not going to say it's 100% predictable, but take a look at their peaks and valleys. Do you see this? So like almost every 3 months, they'll have a valley and then a peak, a valley and then a peak. So Kura, prior to leaving Japan, I was going to make this play, and then I realized, man, once I get back to the US with jet lag, settling back in and everything, it would be a little risky for me to do this. But just showing you my brains and how I'm thinking, for like a quick buck, as they say, if I were to do this, I would buy Kura Sushi. So they're in the business of operating revolving belt sushi that you could just pick right up and pay like $2-3 per plate that you eat. If you're fat, your bill will probably be closer to $30. If you're skinny, maybe $10. But if I had to do it, I would buy Kura Sushi at one of these valleys and then sell out of them at one of their peaks. But just like Alaska Airlines, a trend that I was observing is that since 2024, their peaks are getting lower, while at the same time, their valleys are getting lower. Like if this were the opposite trend, where the peaks are getting, like, so for instance, from 2022 to 2024, if the peaks were increasing while their line of support was also increasing, that would be a bullish trend, right? But the fact that it's going the opposite direction, that increases the lever of risk for me by like 10%. I don't even know what made me go on that rant. But just to show you that it's healthy to have an open mind and to be fluid like water so that you could adopt best practices across the board. Like if you come across information that's contrary to what you believe in, don't be stubborn and double down. Like if information tells you that you might be wrong or that there's better ways to do stuff or equations to reach the path that you want to go on, being open-minded pays. Like when I first started investing, I was so gung-ho about just one school of thought, right? And then I think by CAGR at the time, I think I slightly underperformed the market or was barely matching it. But once I started applying a hybrid approach and doing a little bit of this and a little bit of that, dude, not only has investing become more fun, but the numbers have been working out in my favor. So it's kind of cool. And that's if you adopt the idea of being a student of life. I think there's some people that hate learning, hate trying out new stuff. And so they stick to what's safe and what's comfortable. And that's okay. That makes sense. That's human psychology. But if you're anything like me, you're open to the idea of Kaizen, continuously improving your process, your methodology, your approach. I think that's what allows you to become a better fill in the blank, a better worker, a better father, a better husband, boyfriend, whatever it is, just to continuously improve the way you do stuff, the way you handle manners. And then there's also a crap ton of financials and banks. Not interested in any of these. I mean, I was, if you guys remember in January, I uploaded a video talking about like, guys, the regional banks are selling off and you might want to pay attention because I think it's a really good opportunity. That was the time to invest in them because all of them have rebounded. And since that video was uploaded, I think they're all like plus 40, 50, 60% in the green. So now I think that ship has sailed. But on Wednesday, we have Google, which I hinted at. The markets, they're going to be holding their breath because they're one of the hyperscalers. Gosh, Google, the past 5 years, 173% into the green. Like, I'm not even jealous. I'm just really happy. I'm happy for whoever invested in them. Like, if you bought into the fear of 2022 or bought into the fear right here, I know I did. Congratulations, right? So buying into the fear pays off. High risk, high reward. What I mean by that is it could also have gone the other way, negative 90%. But in the case of Google, it went in the positive. There's also Tesla, Philip Morris. I want to circle back on Philip Morris because I just sold out of Altria at I think $70, $72 a share. So even Philip Morris, they're in the business of selling tobacco products. Past 5 years, 95% into the green, but I've always been biased towards Altria, and they're currently $74. So since I sold out of them, they went up by additional $4.21, and that's okay. I'm not going to lose sleep over that. You know, between you and me, I don't know why I didn't buy the dip right here for Altria at $54. Actually, I remember why. I think that's when I was going gung-ho about buying into the tech and software sell-off. So I think my attention deviated away because I think Altria is probably one of the best dividend compounders with cheese. Like if you want to grow a portfolio where you just buy a dividend stock and allow it to compound for 20, 30, 40 years so that you live off passive income, Altria belongs in that conversation. So if you take a look at their dividend profile, 5.7% dividend yield, 57 years of growing their dividend. So think about it like this, right? Through every recession, through every crisis, through every war, Altria raised their dividend. They never cut it in 57 years. So when you want to talk about a dividend compounder with cheese, Altria's definitely a part of that conversation. 26% single trading year, that's also really good. Obviously, I think their valuation is seems low on paper, but it's fair. For a company like Altria, they usually here, let me pull it up. Their trading multiple is usually there it's in the single digit, 9 or an 8, and right now it's at a 13. So historically, when you compare Altria to their own valuation, they're expensive. And that's why for me, when I sold out of them at $70, for me, it was the right call because I wanted to sell them as they reached this. I'm not going to say irrational because that would be something like a 50 or 100 PE for a tobacco company that's been around for hundreds of years. But I wanted to sell out of them because I only had like 5 shares. One day, I'm going to dump a lot of money into Altria once they get to a lower price point. As a matter of fact, I'm going to write it down in my journal right here. I think I'm going to sell some puts on them, probably at like $45, $49 a share, so I can jump back into them once they go on an irrational sell-off like they did at the end of 2025 going into 2026. So maybe I should, like that was an arbitrary price, by the way, 45. I don't know. Maybe it'll be something like 55. But Altria is one that I do want to buy back in. Their ServiceNow, one thing that I noticed about ServiceNow is out of the whole SaaS landscape, which is software as a service, so companies like Duolingo, Palantir, and all of them, ServiceNow, when it's a green day for the software space as a whole, they go up much higher. But when it's a red day, they go down much further. Now, me personally, I do like ServiceNow, okay? Because I think of them as a tier 2 backbone for the enterprise that connects all the financial operational departments to one another. It's solid. I think of them the same way that I think of SAP, Oracle, legacy line of business, not the Oracle that they're trying to become, which is a data center for OpenAI. As a side note, I really do like Oracle because I told you, if you're bullish on TikTok, I'm bullish on TikTok. I don't like TikTok. I'll go on record by saying it. I don't like it. But you can't invest in TikTok. But you can indirectly through Oracle. And so I like Oracle for different reasons. But all that to say, ServiceNow, I do like them. But all else being equal, I went with SAP because I'm way too bullish and concentrated on US business operations. And I decided that with the current political climate and the party in power and how they're severing relationships in the EU, NATO, and everything, I thought it would behoove of me to at least diversify my portfolio to have at least one company that's based out of Europe that also happens to do business with US operations in case the relationships continue to sour, which I don't think it will. I think the next president that we elect will go around, kiss ass, shake hands, say sorry, and things will be okay again. You know, kiss and make up. So I went with SAP, and SAP also has a dividend profile, whereas ServiceNow does not. But if you're invested in ServiceNow, I don't blame you. I think the numbers that they're executing are absolutely juicy, and it's really good. With ServiceNow, I think I would buy them depending on the commentary of their earnings, which I don't think it's going to be bad. I could be wrong. Here, let me drink some water. I'm getting a little dehydrated here. So my whole thing is, because they have more aggressive volatility, if things are bad, I can absolutely see them dropping down to 90, maybe 88 a share on earnings day, Wednesday. And I can also see them jumping up to 124 and 125. So ServiceNow I do like and I'll be monitoring. For me to pull the trigger, gosh, I don't want to come across as too bearish, but I would need them to fall really far. I don't think that's going to happen for me. There's also Moody's. I hope you guys bought the dip from Moody's, one of the credit rating bureaus. If you bought the dip right here, when they dropped down to 412 a share, now they're 510. That's a pretty good return. Past 3 months, 14%. I did not buy Moody's, and instead I bought S&P Global because they're more diversified across other lines of business rather than just hyper-focusing on credit. Which for me, when your business is just concentrated in one space, that adds a lot of elements of risk. right? But if you have a diversified portfolio where you have different endeavors like Amazon does, like retail versus pharmacy versus streaming, if one thing lags behind, your other lines of business makes up for it, or they should be. Their CME group, which we did a deep dive on the company on this channel, I really like them. And they were selling off not too long ago because I think the prediction markets are launching very similar stuff to what you can do through CME. And it's basically, if I had to sum it up, it's a betting platform for the wealthy and the rich. You're not going to see Gen Z buying commodity future pricing for oil. But rather, they could do it through a prediction market, one of the startups. So this is one of the older companies. I still think they're very high quality, but they thrive when there's volatility. But they've been falling a lot in the recent days because of competition coming up, and they no longer have an economic motive where you can bet on the price of corn, on the price of beef, on the price of oil. Now there's competition. In hindsight, I almost pulled the trigger, but I did not. Here's another freebie. I usually only give price targets on Patreon, but for me, CME, I would jump in at around 199. They did get close to it at 218, so we'll see what happens on earnings. I definitely think there is potential for them to get massacred or for them to jump right back up to where they were prior to the competition news and be at like 298. And then there's also Waste Connections. If you guys follow my Dividend Compounders with Cheese public portfolio series, you will know that I'm really bullish on Waste Connections. And it's a position that I buy and sell out of pretty frequently. Having said that, I know their valuation is a little fat right now, and that's because they're a defensive growth company. Not only do you invest into them for the utility aspects of money coming in every month from people paying their garbage bills, but you're also paying for the future of growth. Really like this one. Now, this is where I'll save it, okay? Because I've been giving too many freebies for fun. If they fall to an XYZ price after earnings, I'm getting right back in. Crown Castle, Cell Tower REIT. This one, guys, if you're invested in, I would be very careful. Because right now, I think the name of the game is to do satellite-based cell service. And so when you think about the traditional modality of having cell towers, like the 5G networks, like it'll work for now. But in the future, I think the markets are pricing in that satellite-based cell service is the way forward. So they're suffering right now. They're suffering. Wyndham Hotels and Resorts, Travel and Leisure. That's the timeshares arm, a spinoff of this right here, Wyndham. Let's see, CalMain. So remember how earlier I talked about I prefer businesses that have a balance sheet that's flush in cash with little to no debt? Now, me personally, I would never invest in CalMain, but if you do, I can't blame you because it is a pretty high quality company. I think they're responsible for like 30% of all the eggs sold in the US. So it's a commodity business, and I don't really like investing in commodities. The reason why their top line has been decreasing is because for the past 12 months, the price of eggs have been coming back down to earth. When there was the bird flu going around, I think in 2024, or was it 2025, they increased the prices and kept the prices pretty high for a while, and that's what made them get in a lot of trouble because they were price gouging the consumers. I think at one point, I was living in Japan, so I don't know the full details, but I think here in the US, weren't you guys paying like $5, $6, or if you live in New York, you were paying like $9 for a dozen, right? And these guys, they kept that price high longer than they had to. They're like, wait, hold on. If the consumers are still buying our eggs for $8, $9, why don't we just keep it higher? Until they got in trouble, and that's why the price of eggs, at least where I'm in the deep south, and I will tell you that a cost of dozen eggs is about $1.40. And that's why their top line is going to continue decreasing. But regardless, let's go to their balance sheet. $1.1 billion of cash on the books. So when you see cash and short-term investments, what that means is highly liquid investments that can turn into cash in the next 72 hours. If we scroll on down and take a look at total debt, oh, what do you know? Since fiscal year 2021, they've had no debt on the books. They have zero debt. And that's why I said, if you're invested into them, I don't blame you. Their books, probably one of the best I've ever seen. I think there's another company that has a better balance sheet than they do. Okay, I cannot remember off the top of my head. But anyways, Calmaine. And to be honest with you, I am not interested in investing in them. Because if you take a look at their forward trading multiple, a 43. A 43. Can I just go back on my soapbox and say for one more time, Microsoft, SAP, Meta, their forward trading multiple is like a 19 or maybe even a 20. So why the heck would I ever want to buy a chicken egg business that's twice as expensive, right? Anyways, let's see if there's anything else. There's a lot of these regional banks. Okay, I want to talk about Getty Realty. I think I went on record on this channel by talking about how I missed the boat by never paying attention to Casey's General Stores, and I regret it. So if you take a look at Casey's General, ticker symbol KC, they're probably one of the best performing stocks that's not a semiconductor chip. That's not a memory RAM SSD player. Past 5 years, 340% into the green. So Casey's, depending on where you live in the US, think of them the same way that you would think of Wawa's. If you're from the East Coast like I am, my hometown is DC. Or Buc-ee's, if you're from the South, like there's Buc-ee's all over here. Casey's is basically the same thing as Buc-ee's and Wawa's except for the Midwest. It's a place where you get gas while at the same time you go in to buy fast food. And apparently their pizza business has been crushing. And I even watched this like 20-minute documentary about Casey's General Stores, and I was like, darn it. It's such a high-quality compounder. This is a company that I had many chances to buy into since I started investing in 2019, and I just never did. I just never pulled the trigger because I was like, wait, what, a gas station business? No. Think about it, guys. You have to fill up gas, what, every week, every 2 weeks? It's something that you have to do, right? And when you do that, you're forced to go to, I don't know, ExxonMobil, Shell, whatever, okay? But for some people, they're gravitating towards a Casey's to get their gas and to get pizza. So it increases the touch point with the customer on a weekly basis. The frequency interval, the ability for a customer to buy something in their convenience store plus getting gas, dude, love it. And so, since I missed that boat, here's a company that almost exclusively has a real estate portfolio. It's a REIT, okay? Getty Realty. No, this is not Getty that has the copyright for all of the images on Google. But this is Getty Realty. They have a real estate portfolio full of Wawa gas stations, of Casey's General Stores, and Buc-ee's. Are you getting my drift right now? So, this right here is on my radar. Yes, they're exploding in valuation. That's because their tenants have been crushing as well. But if they sell off, I'm jumping in. How do I know this? Sometimes after earnings, they go on massive sell-offs, as you can see. It's not a smooth, steady ride for Getty Realty. So I'm almost hoping it happens again so I can buy in. And don't be surprised if on a future upload of the public portfolio series, I'm like, hey guys, I bought into Getty Realty. Here's why. Very high quality. Because they're the landlords of the gas station business that's booming right now. And in the future, the gas station business can turn into EV charging stations while sustaining their pizza and burger operations. And that's why earlier when I was talking about Domino's, they really don't have an economic moat. Take a look at some other gas stations that don't have their own in-house pizza. They'll still be serving pizza by like the Hunt Brothers Pizza or some of the other ones. And then these are all regional banks. If you see Bancor or Bankshares, they're all regional banks. Intel, I'll always go on record by saying I got it wrong with them. I made a deep dive video talking about Intel at the end of 2024 saying, guys, I'm a little scared. Where was it? Yeah, the video was uploaded when they were like $20 a share. I said I was scared because I have no reason to believe through their financials and their fundamentals and their recent earnings to think that they're going to crush or that things are going to turn around. Because when I made that video, this was what I was working with, right? 2022, 2023, 2024 data, and it looked rough. It looked hideous. I got it wrong. Because had I just bought into Intel, bought into the fear, here's the thing, I only like to buy into the fear if the financials and the fundamentals are intact. Mainly, that's what happened with United Health. Even though people were saying, oh, United Health is going to go belly up, they were still crushing. They were still printing cash. Intel, on the other hand, their free cash flow went negative. They cut their dividend. Their top line was decreasing. I had every variable and reason to believe they were going to sink. And that's why I didn't pull the trigger. But there's some people out here, you don't care about the data and the numbers, and you just bought Intel. You bought into the fear. I wish I could do that. I'm being sincere. I wish I could do that. But as a rational guy, I cannot. If I know the numbers are not on your side and they're on a downward trend, I can't buy into it. Because at the end of the day, when I buy into Intel, I'm holding onto a company where the roof is on fire. And I'm like, wait, dude, I don't know about that, man. But had I bought into them for simplicity's sake at $20 a share, and I sold out of them at freaking, what is this? June at 133 a share, I would have been so happy. I got it wrong. I said Intel is a prove it to me business, and I would watch you from the sidelines. And consequently, I didn't put a single dollar into them. Just to show that I'm not always right. I got it wrong. There's RTX, a defense compounder I really like. There's T-Mobile. There's Thermo Fisher Scientific. They're basically the cousin from Pennsylvania for Danaher. They do the exact same thing. And then there's SAP, one of my core positions. Honestly, I don't know what's going to happen, right? I think their business has been businessing, and they've been migrating to SAP Cloud. They're one of the last ones to adopt the cloud business, whereas Microsoft, Amazon, and Google did it years ahead of them. So for SAP, I think it's more of a slow and steady mover. I guess on a quarterly basis, I mean, everything looks fine, right? It's up and to the right. There is a little bit of seasonality baked in. It looks like every winter they get their highest. I'm assuming that's when companies budget for software. It's either you use it or you lose it, and maybe they start buying some add-ons that SAP is selling. But anyways, I'm a little nervous. Because I genuinely do not know how their earnings will go on Thursday. Maybe I'll double down and buy more shares depending on the narrative. We'll see. Go scroll on back to Thursday. There's also Union Pacific, a railroad conglomerate. Lockheed Martin. Can we just talk about Lockheed Martin for a little bit? Ticker symbol LMT. Let me drink some water. During the height of all of the craziness and the geopolitical tensions around the world, they did reach a high of $6.92 a share. I did not sell them at $6.92. I sold them right here at about like $6.30 a share. I did not time the top perfectly, but I think when it was all said and done, I walked away in the green, 33%. I really liked them. Their last earnings, atrocious. It was a mess. Just like the one prior to that and a year before. Somehow Lockheed Martin, they've just been having really ugly earnings quarter after quarter. I remember last summer when I bought into them, let's see, do the 5-year picture so you can see. Last summer, they went on a sell-off and they dropped down to $4.20 a share, and I bought into them, I think, at like $4.17, $4.18 a share, because they took a $950 million loss because of some setbacks in their classified projects. Keyword, they're being classified. So we, as the shareholders, we don't even know what happened. We just know that things didn't go well and they had to pay $950 million. I still think it's a very high quality machine because they're responsible for pumping out drones. Most people don't even know, but they have a subsidiary unit called Skunk Works, and they make a lot of stealth projects. For me, that's why I'm so bullish on, but they're also the parent company of fighter jet planes and space equipment. So when you think about the trajectory of their future, I'm absolutely bullish on. For me, though, with Lockheed Martin and how volatile their history really is, I would buy them on the dip and sell out of them during their irrational peaks like that. And please don't be mad at me, but I kind of hope they sell off so I can jump back in. And because after I sold out of them in the springtime, kind of made me sad because I don't have any exposure into the military stocks anymore. And I feel like I made a name for myself by always saying military stocks are undervalued, they're undervalued, and I put my money where my mouth is. And yeah, they really helped my CAGR. Lockheed Martin, Huntington Ingalls, and Oshkosh Corporation. But the fact that I'm not invested in any of them anymore, I'm like, you know what I'm saying? But anyways, we have another railroad conglomerate in Norfolk Southern. We have Digital Realty Trust. It's a REIT that rents out data center warehouses. There's Comfort Systems USA, probably the highest quality HVAC out there. Past 5 years, 2,100% in the green. Really like this one, but I just don't think I'll have the opportunity to buy them because I think that's way too expensive on a per share basis, even accounting for fractional shares. The valuation being a 48 or a 37, depending on how you spin it or look at it, I'm like, yeah, I don't know. But if for some reason they do fall back to their 1 year low of 500 a share, yeah, I'm jumping in. I'm absolutely jumping in. But at 1,500, let alone 1,200, no, there's other opportunities. And then there's NASDAQ reporting, there's Edwards Life Sciences. They're also, for them, their portfolio is heavily concentrated. Sorry, let me back it up a bit. I'm so excited. Medical device player, portfolio heavily concentrated on artificial heart valves and accessories. Unlike other medical device companies like Medtronic and Abbott, that's a little more diversified. I like them, but not as much as I like Abbott and Medtronic. There's also Roper Technologies, a software conglomerate that has a portfolio that caters towards the unsexy and undesirable business operations like government, municipalities, court systems, police departments, Albertsons companies. One of the biggest grocery chains here in the US. I think their only real competitor is Kroger's. And I say that because Walmart has the biggest market share in the US for groceries, and they're not competing with them. Instead, they're trying to fight with Kroger's. Guys, I'm losing steam. I haven't eaten breakfast or lunch yet, so I'm going to jump on over to the Friday, and I'm going to close this one out. When we take a look at Friday, there are some exciting names, including American Express, Next Era Energy, which, by the way, they announced that they were buying out Dominion Energy, which I only invested into one energy utility stock, and that's Dominion. That's because I got my MBA in Virginia. And at the time, I was paying my electricity bills to Dominion. And I was like, hold on, if I'm going to be paying you for my electricity bills, I want you to pay me back in the form of a dividend. Really funny investing thesis. But anyways, Next Era will buy out Dominion just to strengthen their portfolio of powering up the data centers. On over to American Express. I'll talk about them for a little bit because I went on record by saying when it comes down to Capital One, MasterCard, Visa, and American Express, my number one is American Express. I'm not invested in them, but I will say this. Am I crazy to think that because of the World Cup and thousands of people spending money on travel, hotels, and restaurants, that it's going to be good for them? Now, I don't think it's going to be reflected in this most recent earnings because depending on their quarterly breakdown, how does it break down? How does it shake out? It should be April, May, and June. I guess they'll see a little bit of it. But anyways, I think it's going to be good for them. I'm really bullish on American Express if we go further into a K-shaped economy. Yeah, I don't want to buy into them right now. They would need a bigger pullback. But on the topic of American Express and the World Cup, I'm kind of salty about how things panned out. Every single one of the teams that I was rooting for, they got knocked out. The United States, Canada, Mexico, Korea, Japan, Norway, and all of the other underdogs. I'm a weird guy. I like rooting for the underdogs. It just didn't work out that way. They all got eliminated. So I suppose for the final that begins here in the next 30 minutes, gosh, I guess I'll be rooting for Spain. I don't really care if either country wins, Argentina or Spain, but I guess if I had to pick between the two, Spain, because I think the favorites right now is Argentina. With that, that was a pretty long one, right? Some good news. My studio gear from Japan just arrived. I'm so freaking excited. So I'll be setting that up after I finish editing and uploading this podcast. And after this one goes up later on in the week, an IBM business deep dive. So if you're not subscribed already, you should, because I've been spending a lot of time researching about IBM, which is a company that reported earnings last week and they got absolutely demolished, right? As we talked about. They went from roughly 300 a share, dropping all the way down to 204 a share. So I think a lot of people are wondering, is it a good time to buy into them? And I will tell you what I think. Now, having said that, I love you guys. Stay safe. Good luck in the stock market, and I appreciate you for supporting the channel. I really mean that, because there's other YouTubers out here that you could support, but you choose to hang out with me and support me, and I am thankful for that. I'm grateful, and I don't take that for granted. All right, love you guys. See ya!